Are you looking to diversify your portfolio with foreign stocks? But not only that, you want exposure to growth equities. Today I will cover my top 3 foreign growth ETFs. I will also show their pros and cons, so you can make the best investment decision possible. Also, stay to the end of the video, I will reveal an interesting observation. It looks like that international value stocks, which tend to be more dividend-rich stocks, did better than their growth counterparts. And this raises an interesting question. Should you even consider foreign growth stocks for your portfolio? Foreign stocks did exceptionally well in 2025 by outperforming American markets. Now, this was largely thanks to the depreciating US dollar, but the S&P 500 bounced back and narrowed that gap since then. Foreign equities showed persistent underperformance over the last 10 to 15 years, but this has not always been the case. The US and foreign stocks trade the top spot often. Most of the time it coincides with the dollar getting stronger relative to foreign currencies. This is not surprising. When US stocks are gaining ground, usually it is a sign that the American economy is doing well, and that gives a lot of tailwind to the US dollar. Let's quickly look at the summary table. All 3 funds come with reasonable expense ratios. VIGI is the cheapest one, but CGXU charges a somewhat higher fee. Still, it's much lower than the 1% expense ratio for the Morningstar Foreign Growth Fund category. But CGXU has a materially higher portfolio turnover of 53%. Portfolio turnover is indicative of how often a given fund trades. The higher this number, the more trading costs an ETF incurs. These trading costs are not part of the fund's expense ratio and can drag total returns over time. We also see that VIGI has the highest top 10 concentration. CGXU is not too far away either. Of the 3 funds, EFG by iShares is the oldest. It has been around since 2005. Note that VIGI and EFG are passive index funds. Conversely, CGXU is an active fund, meaning its managers sit all day and pick stocks for his portfolio. This could be a good or bad thing. We will come back to that shortly. Also, both VIGI and CGXU invest in developed and emerging markets. EFG invests only in developed equities from the EAFE countries. Depending on your goals, one could be better than the other. Let's start with VIGI. It may seem a bit strange that I chose this fund. It has this dividend word in its name. If we look at how Morningstar classifies VIGI, it sits on the border between growth and blend. Blend funds are a mix of growth and value. The S&P 500 ETFs are blend funds, for instance. VIGI focuses on high-quality stocks with a history of paying dividends from both developing and developed countries. And its main requirement is that a given stock must have a 7-year history of paying growing dividends. And if a given stock misses even one dividend payout, it will have to wait another 7 years just to pop up on VIGI's radar. Then VIGI sorts its candidates by their yield, and later it takes a haircut of 25% from its top, meaning it eliminates all the stocks that land in the 25 top percent. And the main reason probably behind that is that the ETF wants to eliminate any value traps that potentially sit there. And all the remaining stocks that eventually make into the VIGI portfolio are weighted by their market cap with a 4% exposure limit. Market cap weighting promotes stable and larger companies. But what's amazing about the VIGI main filter of 7-year history of dividends is that these stocks that end up in its portfolio tend to have growth characteristics, which is amazing. And at the same time, these stocks, they also tend to be more defensive in their nature. Next, we have EFG by iShares with a focus on Europe, Australasia and Far East. This fund excludes Canada and emerging markets as the name implies. EFG's underlying index sorts stocks based on their growth and value characteristics. And among metrics that the fund looks at are dividend yield, earnings growth and sales growth. And so those stocks that end up in the top 50% in terms of growth will eventually make into the EFG's portfolio. Finally, we have CGXU. This fund has no index to track. Instead, it has several managers responsible for picking its stocks. The Capital Group, which manages CGXU, is known for its multi-manager approach. This is their legacy from their famous American funds. CGXU has 4 listed portfolio managers with over 30 years of professional experience. Typically, each manager handles a specific sleeve of the portfolio. For instance, one manager could be handling only emerging market stocks, while the other may be focusing more on developed markets or a specific region, for instance like Europe. With several managers in place, the risk of something going terribly wrong is lower. And each manager at the Capital Group is also supported by a large group of analysts. Still, the risk is there. If a given especially important manager leaves the fund, or he loses his touch, CGXU performance may suffer. That's a big problem for actively managed funds. Many of them tend to experience the so-called reversion to the mean. After years and years of outperformance, their returns become average or worse, lower than average. So if you go with CGXU, this is definitely something to watch out. Also, the fund doesn't list any caps or limits on its exposures, so we can safely assume that anything goes. Another thing about the Capital Group's ETFs is this. Many of them are some sort of continuation of an investment strategy that its other mutual funds follow. And I looked at other ETFs by the Capital Group, and this has been the case many times. The upside from this is that likely there is some sort of strategy already in place for the fund, and it was probably before that, maybe like 5 or 10 years, or even more in some cases. And likely there could be some even rules for selection of stocks, and so this really helps to streamline the funds and its selection process for stocks. Now let's compare our funds. The first thing to observe is that EFG has the biggest tilt to the growth factor. Likewise, it has the highest tilt to quality. Quality factor means that its stocks have higher profitability and lower debt leverage. Conversely, VIGI has shown more tilt to value. As we will see shortly, this has been a big contributing factor for its positive performance. Of the 3, CGXU has the highest allocation to emerging markets. It stands at 17% now. VIGI comes second with 7% exposure to developing countries. As expected, EFG has 0 allocation there. The thing about VIGI is that its exposure to emerging markets has not always been this low. Back in 2020, VIGI allocated 25% of its portfolio to developing countries. A lot of it came from China and India. I will come back to emerging markets performance shortly. All these 3 international growth ETFs go heavy on Japan. As expected, EFG has 0% allocation to Canada. But CGXU looks more balanced across different countries. Their biggest emerging market allocation comes from India, China, and Brazil. Probably CGXU and VIGI may allocate even more to emerging markets over time. As for sector allocations, we see that VIGI goes heavy on financials. This is not surprising. Many dividend-paying stocks reside in this sector. Conversely, we have EFG with a large allocation to industrial stocks. When it comes to growth, developed markets have many more growth companies in the sector. This isn't like the US, where tech dominates growth equities. One notable thing about EFG is its exclusion of Asian developed equities. Stocks from Hong Kong, Singapore, or Taiwan are not part of EFG's portfolio. A notable stock excluded is Taiwan Semiconductor Manufacturing Company. As for CGXU, its sector allocations look more balanced. Industrial, tech, and financial stocks take the lead there. Next, let's take a look at performance. CGXU is a relative newcomer. We see that since 2022, CGXU underperformed the other 2 funds, but VIGI and EFG returns were neck and neck. If we start zooming out, VIGI dominance becomes even more noticeable. Why would this be the case? After all, VIGI is the farthest from the growth fund, right? The reason has to do with how foreign value stocks did much better than foreign growth equities. Here's a chart showing how value versus growth stocks performed in developed markets. This graph excludes emerging markets. We see that the outperformance in the last 5 years has been staggering. What is happening there? We will have to come back and see how interest rates began rising after COVID. Rising interest rates are not particularly helpful for growth stocks. Growth stocks are like long-duration investments, and most of their value sits far from today. In other words, their cash flow growth realization is far from today and way into the future. And future cash flows must be discounted, and interest rates is an important component in calculating the discount factor. So the higher the interest rate, the higher the discount factor, keeping other things constant, of course. With higher discounting, the value of long-dated cash flows will be lower, and hence the growth stocks tend to lose their value in the rising interest rate environment. But of course, this is a rule of thumb, and it assumes that other things remain constant. For instance, when interest rates rose in 2022 in the US, the stock market panicked. Many growth stocks slumped as a result. But even with rising interest rates, growth remained strong. It was especially true for American tech companies. Hence, their growth overpowered rising interest rates. The US growth equities have been up since then. But that's not the story in foreign markets. Likely the foreign growth stocks did not have comparable growth prospects, and hence they lacked their value counterparts. Conversely, many foreign value equities greatly benefited from rising interest rates as well as inflation, and this was especially pronounced in the commodities and financial sectors. For instance, foreign banks and oil companies greatly benefited and were big winners from all this. If we zoom out, foreign value did not always do better than foreign growth. Before 2020, foreign growth shined. If we zoom out to 1999, foreign value stocks smoked foreign growth on a cumulative basis. So we see that foreign value tends to do better in overseas developed markets on a long-term basis. But this outperformance comes in cycles. Sometimes foreign growth does better, especially in low interest rate environments. This has likely helped VIGI to do so much better than the other two funds, especially in the last 5 years. But will this outperformance continue? Well, it's all path dependent. If, for instance, the interest rates come down, the growth-focused EFG and CGXU will benefit greatly. Here's another thought, and that is exposure to emerging markets. Both VIGI and CGXU provide it. In the last 5 years, emerging markets lagged foreign developed ones, as we see here. But this has not always been the case. Emerging markets did so much better before 2020. If we zoom out to 1999, emerging markets are clear winners. But we see that there's a lot of volatility with huge drawdowns. It's not surprising. Developing markets come with lots of regulatory, economic and political risks. Take China, for instance. Back in 2020, the Chinese government exerted a lot of pressure on Chinese tech companies. As a result, the Chinese stock market took a nosedive and is still recovering. On top of it, emerging markets had a lot of catching up to do, and they had higher growth potential back in 1999 than perhaps now. So today, maybe these countries are closer to their steady-state growth rates compared to than before. Still, I think there's a lot of growth potential in emerging markets left. So, in light of that, CGXU and VIGI could be a better options for that. Just don't forget that emerging markets exposure comes with a lot of volatility and uncertainty. On a final note, we see that VIGI tends to be the least volatile of the three funds. VIGI emphasizes high-quality dividend-paying stocks. These stocks tend to be more defensive and fall less in down markets. With that, let's conclude and see pros and cons for each foreign growth ETFs that we looked at. The first point is about market exposure. Of the three, EFG is the only one that focuses solely on developed countries. Just don't forget that this fund is also missing on Canadian as well as some other like Asian developed countries, for instance Taiwan. But still, I would not discard emerging markets completely. They may still come back and roar with their growth prospects in the future. In that sense, VIGI and CGXU could be better options. Next, VIGI is probably the closest to value of the other two funds. And so, historically speaking, foreign value equities outperform their foreign growth counterparts. So depending on your view and how you think value will outperform or underperform growth in foreign markets, VIGI could be better or worse option for you. And finally, we should not forget the management style. Both VIGI and EFG are passive index funds. Conversely, CGXU is an active ETF with people picking stocks. Active funds tend to underperform passive index funds. For instance, in the US, roughly 90% of the active funds failed to beat the S&P 500 for the last 15 years. CGXU does have a few mitigating factors in its favor. The fund comes with 4 experienced managers as well as a large pool of analysts. So, given these factors, it may resist the reversion to the mean, if any. But still, this is something to keep in mind. And that's all I have for this video. If you enjoyed it, give it a like and subscribe to my channel for more useful content on investing in the future. All the best, and I will see you at the next one.